Gold just did something it has never done before. Not a spike, not a flash rally, a full weekly close above $5,000. And at the exact same time, a global headline shook markets, Russia returning to the dollar system. But what if that story wasn't real? What if it was designed to move liquidity, to shake weak hands, to create just enough fear before something much bigger unfolds? Because while the noise distracted everyone, China quietly changed the rules of the game, and when gold breaks history, when silver premiums widen, when sovereign headlines start contradicting each other, that's not randomness, that's pressure building. And the real question isn't whether gold crossed $5,000. The real question is, who is positioning before the public understands what's happening? Welcome to Market Metal. If you're over 50 and you've lived through recessions, currency scares, and temporary government promises, then you already know something doesn't feel normal right now. So before we go deeper, gently tap that subscribe button, not out of hype, but out of wisdom. This channel is built for people who think long term, and tell us in the comments, where are you watching from today? Which country? Which city? Let's see how global this conversation really is. The break that changes the frame. Gold closed the week above $5,000 for the first time in history. It did not spike there for a few minutes. It did not briefly touch the number during a thin overnight session. It closed the entire week above that level. For serious market participants, that difference matters. Professional capital does not react to intraday noise. It reacts to confirmed structure. A weekly close represents commitment. It reflects decisions made by institutions, sovereign buyers, and long-term allocators who manage billions, not traders chasing headlines. When gold closes a week above a psychological level like $5,000, it signals that something deeper is unfolding. He understands that markets move in phases. First comes disbelief, then quiet accumulation, then broad recognition. A weekly breakout often marks the transition between early accumulation and structural repricing. The number itself, $5,000, is less important than the confirmation. It establishes a new reference point in global capital markets. Historically, similar moments carried weight. When gold first held above $1,000, it was not treated as a spike. It marked a change in perception after the global financial crisis. When gold sustained above $2,000, it reflected pandemic-driven fiscal expansion and monetary intervention. Each milestone corresponded with deeper economic forces. This move above $5,000 is unfolding in a very different macro environment. Inflation remains elevated compared to long-term averages. Global debt levels are historically high. Sovereign trust between major powers is strained. At the same time, headlines have become more volatile and more influential in short-term price swings. Earlier in the week, a major media outlet published a headline suggesting Russia might return to the dollar system. Markets reacted quickly. Gold and silver moved sharply. Liquidity shifted within hours. But shortly after, Russia's central bank leadership publicly denied any such discussions. The narrative collapsed. They observed something important in that sequence. The initial move was driven by headlines. The sustained move was driven by structure. Gold did not fall apart after the denial. It stabilized. It closed the week above $5,000 despite the noise. For experienced capital allocators, that resilience matters more than the volatility itself. When an asset absorbs negative headlines and still closes strong, it suggests underlying demand. At the same time, another development was unfolding quietly. China announced tighter enforcement on off-exchange gold and silver derivatives. The language focused on leverage restrictions, scrutiny of fractional reserve practices, and stronger physical settlement standards. For many retail investors, those phrases mean little. For institutional observers, they signal potential shifts in how price discovery functions. Rehypothecation allows 1 ounce of physical metal to support multiple paper claims. It increases liquidity but also creates fragility. If more participants demand delivery than available supply, pressure builds quickly. When regulators restrict such mechanisms, it narrows the gap between paper supply and physical availability. They began to consider a simple question: what happens if physical enforcement becomes stricter while sovereign tensions rise and debt burdens expand? Meanwhile, Western spot prices for silver traded around $77, while Shanghai prices held closer to $86, maintaining a premium. Gold in Western markets traded above $5,040. Those price differences reflect more than geography. They reflect separate liquidity pools and different regulatory structures. He notes that premium gaps between East and West often indicate regional supply-demand imbalances. If Shanghai consistently trades at a premium, it suggests stronger localized demand or tighter inventory conditions. Arbitrage typically closes such gaps over time, but persistent divergence may signal structural stress. Another data point stands out. Gold exchange-traded fund holdings have not reached their 2022 highs, even though price has nearly tripled since then. In previous bull phases, rising prices attracted retail and institutional ETF flows. This time, ETF holdings have declined while price advanced. That divergence suggests something unusual. Central banks have been accumulating physical gold reserves at a steady pace. Public data confirms this. Yet broad retail enthusiasm appears muted. If price rises without crowd participation, it often means early-stage repricing rather than speculative mania. They understand that markets can rise for two very different reasons. One is emotional buying, driven by headlines and fear. The other is strategic allocation, driven by long-term policy shifts. The current pattern resembles the latter more than the former. Still, discipline requires examining the risks. A move from lower levels to $5,000 represents significant appreciation. Parabolic advances can correct sharply. Silver has not yet reclaimed certain technical resistance levels on shorter timeframes. Seasonal liquidity changes can distort pricing. Markets rarely move in straight lines. Professional observers do not assume inevitability. They evaluate probabilities. They ask whether sovereign behavior, fiscal realities, and regulatory shifts align with price action or contradict it. The fiscal backdrop adds context. The United States has reported substantial deficits in the early months of the fiscal year. Net interest payments on government debt have risen sharply compared to previous years. A large amount of Treasury debt is scheduled to mature within the next 12 months. Rolling that debt requires continued demand at sustainable interest rates. They do not treat deficits as immediate collapse triggers. Governments have operated with high debt levels for decades, but they recognize that refinancing risk increases when deficits remain elevated and interest costs rise simultaneously. In such an environment, gold functions differently than a speculative asset. It becomes a balance sheet stabilizer. Central banks hold it not for yield, but for neutrality. It carries no counterparty risk. It is not tied to one nation's fiscal policy. When gold closes above $5,000 on a weekly basis, while geopolitical narratives shift and regulatory changes tighten physical markets, decision makers pay attention. The question is not whether gold can pull back. It likely will at some point. The question is whether the breakout reflects temporary enthusiasm or long-term repricing of sovereign risk. He concludes that part one is not about excitement. It is about framing. A weekly close above $5,000 establishes a new baseline for analysis. It forces businesses, investors, and entrepreneurs to reassess currency exposure, capital allocation, and geopolitical risk assumptions. The breakout alone does not answer what comes next, but it changes the starting point of the conversation. And in strategic analysis, where the starting point sits often determines the quality of every decision that follows. The multipolar currency shift. When Russia publicly rejected any return to the dollar system, most observers treated it as a political statement. Serious capital allocators did not. They treated it as a signal. In global finance, signals matter more than speeches. The headline that initially circulated suggested a possible reintegration into the Western dollar framework. Markets moved instantly. Liquidity responded before verification. But when Russia's central bank leadership denied any such discussions, the narrative shifted from possibility to exposure. They did not focus on the embarrassment of a misreported headline. They focused on the deeper implication. Russia felt no need to soften its stance. For decades, the dollar system has functioned as the backbone of global trade. Commodities, energy, shipping contracts, and sovereign reserves have been priced and settled primarily in US dollars. The system offered stability, depth, and trust, but it also created dependency. Now that dependency is being tested. He studies currency systems the way engineers study bridges, not when they are strong, but when stress begins to appear. The question is not whether the dollar collapses tomorrow. The question is whether the system's monopoly status slowly erodes. Russia's rejection must be viewed within a broader pattern. Over the last several years, bilateral trade agreements between non-Western nations have increasingly used local currencies. Energy settlements between major commodity exporters and Asian buyers have diversified away from exclusive dollar pricing. Gold purchases by central banks outside the Western alliance have accelerated. This is not rebellion. It is redundancy. They understand that redundancy reduces vulnerability. When nations diversify settlement mechanisms, they reduce exposure to sanctions, liquidity freezes, and political pressure. In business terms, they are building parallel infrastructure. For entrepreneurs and business leaders, the relevance is direct. Currency exposure is often invisible until volatility appears. A company that invoices internationally in dollars may assume stability. But if trade blocs increasingly settle in alternative currencies or commodities, exchange rate dynamics can shift quickly. Russia's position, therefore, is not isolated. It is one node in a growing multipolar architecture. He asks a simple but uncomfortable question. What happens if global trade gradually fragments into regional currency zones? The dollar remains dominant in global reserves. Its financial markets remain the deepest in the world. U.S. Treasury markets still serve as the primary risk benchmark. But dominance and exclusivity are not the same thing. In a multipolar system, the dollar may remain strong, but no longer singular. This distinction is critical. Gold's breakout above $5,000 occurred at the same time that de-dollarization rhetoric intensified. That timing is not accidental. When confidence in a single settlement system weakens, neutral assets gain relative importance. Gold does not belong to one nation. It does not depend on fiscal promises. It does not require political alignment. In periods of structural currency transition, neutral assets become strategic tools. They observe central bank data carefully. While retail ETF holdings have declined, sovereign institutions have continued accumulating physical reserves. That divergence reflects long-term positioning, not short-term trading. For business leaders, the lesson is not ideological, it is practical. If currency systems become more fragmented, companies may face higher transaction costs, more volatile exchange rates, and complex regulatory compliance requirements. Hedging strategies that worked in a unipolar system may require revision. Meanwhile, fiscal realities amplify the tension. The United States faces substantial debt maturities within the next 12 months. Refinancing large volumes of government debt requires consistent demand. If foreign central banks reduce incremental purchases, domestic buyers must absorb more issuance. He does not predict a funding crisis. He observes a shift in marginal demand. Marginal demand determines price. If sovereign buyers gradually diversify away from dollar reserves, even modest changes in allocation can influence yields, liquidity, and currency strength over time. Russia's public stance therefore becomes symbolic. It communicates that alternatives are not theoretical, they are operational. China's trade settlements in yuan, regional commodity exchanges, bilateral agreements that bypass traditional clearing systems. These developments build slowly, but once parallel rails exist, behavior adapts. They recall historical transitions. The British pound once dominated global trade settlement. Its decline did not occur in a single year. It unfolded gradually, accelerated by geopolitical shifts and fiscal strain. The dollar eventually replaced it, not by collapse alone, but by offering deeper markets and greater trust. Now the dollar faces a different dynamic. It is not being replaced by one clear successor. It is facing diversification. In such an environment, gold's weekly close above $5,000 takes on added meaning. It becomes less about inflation hedging and more about systemic neutrality. He sees three possible paths. First, the dollar retains dominance, and diversification remains marginal. Gold stabilizes at higher levels but does not accelerate dramatically. Second, diversification expands steadily. Sovereign allocations increase gradually. Gold reprices in stages as confidence redistributes. Third, geopolitical events accelerate fragmentation. In that case, repricing becomes sharper. Professional decision makers do not commit emotionally to any single outcome. They monitor behavior. Russia's rejection of dollar reintegration demonstrates resolve. It signals that alignment lines are hardening rather than softening. Combined with China's regulatory tightening of gold and silver derivatives, it suggests that financial sovereignty is becoming a priority. For young entrepreneurs and business operators, the warning is simple but serious. The environment in which global business has operated for 30 years, relatively stable currency flows, predictable trade settlement channels, and unquestioned dollar dominance, may be evolving. Change in financial architecture rarely announces itself loudly. It emerges through policy adjustments, regulatory shifts, and subtle reallocations. Gold above $5,000 is not merely a price event. It may be a reflection of confidence recalibration. And when confidence recalibrates, capital follows. The next question is not whether this multipolar shift continues. The next question is how physical commodity markets respond if paper leverage mechanisms tighten at the same time, currency systems fragment. That question leads directly into the next structural development. The paper illusion meets physical reality. Most investors believe gold and silver prices move because of demand and supply. That is only partially true. In modern markets, price is often determined first by paper. Futures contracts, leveraged derivatives, off-exchange swaps, and fractional reserve structures create layers of exposure that can multiply far beyond the physical metal sitting inside vaults. 1 ounce can support multiple financial claims. As long as most participants settle in cash, the illusion holds. But illusions only work until someone asks for delivery. China's recent regulatory tightening did not make global headlines the way geopolitical tensions do. It was framed as administrative enforcement. Yet for professionals who understand commodity structure, the implications were significant. They observed 4 clear themes in the new approach: restrictions on leveraged off-exchange derivatives, scrutiny of fractional reserve practices, stronger oversight of rehypothecation, and emphasis on physical settlement integrity. To the average observer, these sound technical. To serious capital, they represent pressure on the paper multiplication mechanism. Rehypothecation allows a single asset to be pledged multiple times as collateral. In metals markets, it effectively expands synthetic supply. Fractional reserve structures allow more claims than physical inventory. Leveraged derivatives amplify exposure without increasing physical backing. If regulators restrict these practices, two outcomes follow. First, liquidity tightens. Second, the connection between price and physical inventory strengthens. They noticed that Shanghai prices for silver continued to trade at a premium to Western spot markets. Around $86 in Shanghai compared to approximately $77 in Western markets. A persistent premium suggests local demand exceeding available supply at current pricing. Arbitrage should close such gaps. Traders buy where prices are lower and sell where higher. But arbitrage requires logistical ease and regulatory compatibility. When regional rules differ, spreads can persist. He asks a simple structural question. What happens if one major market enforces physical discipline while another remains paper-heavy? Over time, physical demand gravitates toward the venue with greater delivery credibility. If participants believe settlement integrity is stronger in one jurisdiction, capital follows that channel. Shanghai Futures Exchange inventories reportedly sit near historically low levels relative to industrial demand. A modest addition of inventory may prevent immediate stress, but the margin remains thin compared to total trading volume. Silver, unlike gold, is heavily industrial. It is used in advanced electronics, solar infrastructure, defense systems, and emerging technologies. Unlike monetary gold reserves, industrial demand does not pause for price consolidation. Production lines require material. This is where regulatory tightening intersects with geopolitics. China controls a significant share of global silver refining capacity. Mining output is one variable. Refining dominance is another. Raw ore without processing has limited utility in advanced manufacturing. Refined silver is the input that matters. If refining infrastructure concentrates in specific regions while financial leverage contracts, physical supply becomes strategically important. They consider the scenario carefully. If China enforces stricter settlement standards and if sovereign tensions persist, physical metal may be retained domestically rather than freely exported. This is not a forecast of embargo. It is recognition of sovereign priority logic. Nations secure what they consider critical. Meanwhile, in Western markets, futures trading remains deep and liquid. Most participants settle contracts financially. As long as delivery requests remain limited, leverage functions efficiently. But structural tension grows when paper claims expand faster than underlying inventory replenishment. He recalls previous commodity squeezes in history. They rarely begin with panic. They begin with quiet tightening. Premiums widen, inventories drift lower, regulatory language shifts from permissive to restrictive. At the same time, analysts such as David Morgan have suggested that governments may view silver as strategically critical, not merely as a precious metal, but as an industrial input for national security and technological independence. Whether such stockpiling occurs remains unconfirmed policy, but the logic behind the argument is straightforward. If a nation relies on imported, refined material for critical systems, it may choose to secure reserves before supply chains tighten. This introduces a new variable. Sovereign demand does not behave like retail demand. It does not respond primarily to price fluctuations. It responds to security calculations. If physical enforcement tightens in Asia, while sovereign accumulation expands globally, the balance between paper exposure and vault inventory becomes more delicate. They do not predict an immediate disruption. They analyze probability distributions. If 90% of speculative gains historically cluster within short time windows during bull cycles, as some analysts suggest, then timing becomes important. Late participants often enter during volatility. Early participants position during skepticism. Gold has already confirmed a structural breakout. Silver remains below certain resistance levels, but continues to trade at meaningful regional premiums. For business leaders and entrepreneurs, the implication is not to speculate impulsively. It is to understand supply chain risk. If industrial inputs experience tightening, production costs rise. If paper leverage compresses, volatility increases. If sovereign policies prioritize domestic security over global liquidity, international trade conditions shift. China's regulatory move may represent simple housekeeping, or it may represent early enforcement of a more physically anchored commodity framework. Markets rarely telegraph their turning points clearly. They reveal them through small rule changes that compound over time. He concludes that Part 3 is about architecture. If the foundation of paper leverage narrows, while geopolitical and fiscal stress rise, physical assets regain pricing power. And when pricing power shifts from synthetic volume to tangible inventory, repricing does not occur gradually. It occurs in steps. The next stage of analysis must therefore consider how fiscal stress and refinancing pressure intersect with this tightening physical landscape. Because currency strain and commodity strain rarely operate independently. The debt clock and the strategic repricing gold above $5,000 is not only a metal story, it is a balance sheet story. Behind every currency stands a sovereign balance sheet. Behind every balance sheet stands debt. And behind debt stands confidence. The United States is currently managing one of the largest fiscal imbalances in modern history outside of declared crisis conditions. In the first months of the fiscal year, the budget gap widened significantly. Government spending continued at elevated levels. Revenues did not keep pace. Net interest costs on outstanding debt increased as higher rates filtered through refinancing cycles. They do not treat this as sensational. Our governments have operated with deficits for decades. Markets have absorbed large issuance before, but scale matters. Over the next 12 months, a historically large amount of U.S. government debt is scheduled to mature. That debt must be rolled into new issuance. At the same time, new deficits require additional borrowing. Refinancing and new borrowing happening simultaneously increases pressure on demand. He does not predict default. The United States retains deep capital markets and global trust, but he observes the arithmetic. When interest expense accelerates toward $1 trillion annually, it becomes a structural component of the budget rather than a marginal cost. Debt begins to compound on debt. Confidence in sovereign debt markets does not collapse overnight. It shifts at the margin. If foreign central banks gradually diversify reserves, if domestic buyers require higher yields, or if geopolitical fragmentation reduces international appetite, refinancing becomes more expensive. Expensive refinancing strengthens the case for neutral reserve assets. This is where gold re-enters the conversation. Central banks have quietly increased gold purchases over recent years. Meanwhile, retail ETF holdings have declined even as price has risen sharply. That divergence matters. It suggests that institutional sovereign actors are accumulating while public participants remain cautious. In previous cycles, public enthusiasm led price. This time, sovereign allocation appears to lead. They understand that markets often move before narratives adjust. Gold's weekly close above $5,000 may represent recognition of long-term fiscal strain rather than reaction to short-term inflation prints. Silver introduces another layer. Industrial demand continues for advanced electronics, renewable infrastructure, and defense systems. If physical supply tightens while paper leverage narrows, silver could experience sharper volatility than gold. Some analysts argue that a large portion of bull market gains historically concentrate in compressed windows. Whether that pattern repeats remains uncertain. But structural alignment increases probability. Now the tension becomes clearer. On one side, large sovereign debt maturities, rising net interest costs, geopolitical fragmentation, regulatory tightening in physical commodity markets. On the other side, deep capital markets, institutional adaptability, technological innovation, historical resilience. They evaluate both. The bearish case remains plausible. Gold could retrace after a parabolic advance. Silver could fail to break key resistance levels. Fiscal deficits could stabilize if growth surprises to the upside. Debt maturities could roll smoothly if demand materializes. Regulatory enforcement could be delayed or softened. Markets are not linear. They oscillate between extremes. But the structural case carries weight. Gold has now printed its first weekly close above $5,000. That level is not symbolic alone. It establishes a new psychological anchor for asset allocators. China has tightened oversight of leveraged paper metals. Russia has publicly rejected reintegration into the dollar system. Central banks continue to accumulate physical reserves. Debt refinancing pressure looms over the largest economy in the world. These events are not isolated headlines. They form a pattern. He frames it carefully. When trust in fiscal sustainability weakens at the margin, and when geopolitical blocs strengthen independent settlement systems, neutral assets gain strategic relevance. Neutral does not mean emotional. It means independent of political promises. Entrepreneurs and business leaders must think beyond daily price movements. They must ask how currency risk, commodity inputs, and sovereign credit conditions interact. If refinancing pressure increases and yields rise, borrowing costs for businesses follow. If commodity volatility intensifies, input costs fluctuate. If currency fragmentation grows, hedging complexity expands. Gold above $5,000 signals that global capital is adjusting expectations. The adjustment may be gradual, it may pause, it may retrace, but the architecture has shifted. He ends not with prediction, but with positioning logic. In times of structural uncertainty, disciplined decision makers avoid extremes. They diversify exposure. They evaluate supply chain dependencies. They reassess currency risk. They monitor sovereign behavior rather than headlines. Markets can remain volatile longer than anticipated. They can correct sharply, even within broader structural shifts. But once a weekly close confirms a new historical threshold, the analytical baseline changes. Gold is no longer approaching $5,000. It has already crossed it. The question is no longer whether the system is stable. The question is how stability will be defined in the next cycle. And that answer will not be determined by headlines alone. It will be determined by balance sheets, physical supply, sovereign alignment, and the quiet decisions made before the crowd recognizes the shift. The clock is not ticking loudly, but it is ticking, and serious observers can hear it.